Hey traders, welcome to another global macro update. We'll be going over quite a bit of news topics this video, as well as just some understanding of what could potentially be playing out in a conflict between a current power and a rising power, which would mean basically the United States and the rising power being China. So first things first, let's just quickly look at the economic calendar for this upcoming week. We have some PMI numbers coming up for tomorrow. We have non-farm payroll, crude oil inventory. The big one, I think, is going to be the unemployment rate here on Friday at 16%. That's unbelievable. We'll see where the actual number is going to be. But looking at the actual economic data coming out in the charts, I am still having the bias that the stock market is not coupled or not in line with the economic fundamentals. That is obviously negative. So I'm going to have a bias of basically having a decoupling of the charts versus the economic data that is coming out. Obviously, it's super bearish, a lot of negative stuff coming, but the market is still moving towards the upside. So we're going to play it safe. We're going to wait until there's a high probability situation, because right now, investors are definitely still not that worried about the economy just yet. It seems like with the SPX, the SPY, the S&P500 still not really making a new lower low. So let's get right into the video here. First thing we're going to talk about is Warren Buffett selling his entire stake with the U.S. Airlines. So airline shares fell sharply again, this time as after Warren Buffett cashed out of its stakes in the 4 largest U.S. carriers. I'm sure that if you are following the financial news, you are aware of this. He did talk about it within his 2020 Berkshire Hathaway annual shareholder meeting. If you're interested in listening to an absolute legend in the fundamental value-based investing approach, definitely worth a watch. It's quite a long time, quite a long video, over 5 hours long, but yeah, has some good information there for sure if you're interested in long-term value investing. He talks quite a bit about the foreseeable future, and I think it does show you the state of the economy if a value investor like Warren Buffett is selling all of his airline stock, all of them, right? He completely liquidated all of his U.S. airlines. And, you know, that, in my opinion, shows you something, because not too long ago, he was talking about how there's still a good purchase and there's still value in there. But with him selling that this low, kind of makes you wonder. Now going on to the aerospace, defense, airline industry. Let me just get a little bit of coffee here and then we'll continue. Boeing raises monster $25 billion in bond offering. So instead of asking federal aid and basically getting a bailout, Boeing on Thursday said it raised a whopping $25 billion in bond offering, and it won't seek federal aid as the aerospace giant faces the fallout from this pandemic. Huge bonds, and we can see that investors are still eating up, still interested in these aerospace basically airline bonds. So, you know, investors are still having an appetite for these types of investments. United Airlines, $1.7 billion loss in first quarter. Airlines are posting their first losses in years because of this pandemic. Another one right here, American Airlines loses $2.2 billion in first quarter as well. First quarter loss in since 2013. The company is burning through about $70 million a day in the second quarter. So massive losses on a daily basis until this pandemic closes, until this lockdown is basically complete and individuals, businesses, basically people are able to fly comfortably for business, for vacation, for any sort of travel. Until that occurs, we're not really going to see these numbers turn positive. So obviously, yeah, very bearish for the overall economy, because airlines were a major key player in a lot of investors' portfolios, because, you know, who would have thought that this pandemic would basically shut down all airlines. All right, now going on to the oil, we can see BP's net profit slide 67% in the first quarter, compared with the $2.4 billion in the first quarter of 2019. We see that the net profit is $800 million for the first quarter, significantly lower than what they had before. So oil is getting squeezed as well. Airlines are getting squeezed significantly. Another post here, Chevron says results will be depressed as long as the oil stays low. Take steps to protect dividends. So some companies, some bank companies are not paying dividends or slash dividends. We'll talk about that in a little bit. But a lot of these corporations are trying to keep their dividend, so then investors are still attracted to owning their equity. If there's no dividend, if they slash dividends, that's potentially going to add additional sell pressure onto the market because investors will look elsewhere for a higher yield. Chevron shares dropped on Friday after the company warned that results will remain depressed as long as oil prices stay low. The oil giant said it was making additional cuts to its capital spending plan. Company's dividend remains a priority for, said the CEO, Michael Worth. So we'll see where this goes. We have seen companies cut dividends, which is going to drive more sell pressure within that stock. Another oil company here, Exxon, loses $610 million in the first quarter. ExxonMobil on Friday reports its first loss in decades as oil prices plunged to historic lows following a drop in the demand due to the lockdown. So we're seeing a ton of corporations in the energy sector have these massive losses due to the drop in oil prices and the lack of demand due to the lockdown. Shell, again, slashes dividends for the first time since World War II. So now companies are actually slashing dividends, and this is going to create, like I said before, additional sell pressure within the market because investors are going to look elsewhere within the market to find their yield. The board at Shell said that it has decided to reduce the oil major's first quarter dividend by 16 cents per share, down from 47 cents per share at the end of 2019. That's a 66% reduction. That's a significant amount of the dividend cut here. So obviously, if you're an investor and if you see your dividend get cut more than half, you might want to be looking elsewhere for your yield. So not awesome, but if you're getting a bailout, if you are understanding, it takes a lot to run a business during these difficult times, you're going to have to do what's necessary, and cutting dividends for your investors may be that thing that you have to do. So yeah, we're seeing a lot of companies do this as well. Oil and gas companies set to lose $1 trillion in revenues this year. That's a 40% decline year on year. Yeah, and I do think it's going to get worse until this lockdown comes to an end and individuals are able to travel by air, by boat, by car, by plane, anywhere. This is not going to stop, basically. Oil and gas is heavily relied on individuals traveling, things traveling. If there's a lockdown, there's not going to be that much traveling, which is not going to create enough demand. And we're going to be in this for the long haul until this lockdown completes. The energy sector is shrinking so dramatically that it's become the second smallest group in the whole S&P index. It was a major key player for a very long time because energy, oil, is a huge sector within Canada, within Australia, within the United States. But now, Alberta, basically, what do they have? They don't really have a whole lot because their entire economy was just built on oil production. And with negative oil prices, with volatile oil, with oil sitting at very historic lows, they're going to have a lot of challenges. So this is going to tie into the more financial breakdown that, in my opinion, is going to happen. Like we saw the mortgage-backed securities in 2008 fail with the CDOs, which then leads to bank failure, bank collapses, and major profit losses in banks and defaults rising, which is going to basically squeeze out banks because they're depending on these assets, what they think is mortgage-backed securities. But if they are not going to be actual assets, they're more liability, because if you think you're going to get owed $500,000 and they default, now you're down $500,000 if they can't pay for it. And these oil and gas companies are raising a shit ton of money through these banks, and we're going to see these banks get squeezed, as well as through the mortgages with people not paying rent, as well as the oil and gas companies not being able to make any money. There's a lot of pressure on banks. So Bank of America posts 45% decline in first quarter profit. braces for big loan losses, corporations as well as individual. Bank of America sets aside $3.6 billion to loan loss reserves in the quarter following similar actions from JP Morgan Chase and Wells Fargo. So this loan loss reserve is basically a pool of money set aside so if there is a major, basically a major loss due to the basically people not being able to pay, which would be a default, then you got to dip into the funds to basically pool the money that you lost due to the defaulted loan. But if you see a lot of them, it's only going to cover a certain amount. So if it's a small amount of people or a small amount of companies who are defaulting, that's not so bad. But if you're seeing greater and greater numbers of people defaulting, and the bank basically just has to take money from their pool, there's a limited amount of money in that pool. So it's definitely a very difficult time for these banks here. Citigroup, first quarter profit tumbles 46% as banks set aside more money for loan losses. So other banks are doing this as well. They're setting up, they're trying to prepare for this wave of defaults, this wave of defaulting loans from corporations and from individuals. So their loan loss reserve was built by $4.9 billion, whereas Bank of America was around 3.6. So you're seeing banks load up on loan loss reserves because you know that they are worried about default rates, similar to 2008. Goldman's profit tumbled 46%. The bank posted strongest bond trading results in 5 years, but Goldman's profits tumbles 46% as well. So you're seeing a lot of these large financial institutions and banks get squeezed. People are losing money basically, and you're seeing people pull funds. So BlackRock, which is the largest asset management firm in the world, their profits sink as investors pull funds. BlackRock reported a 23% drop in quarterly profits as investors pulled money out of its marquee funds and preferred cash management services. The company ended its first quarter with $6.47 trillion in assets under management, AUM, down from $7.43. So they basically pulled $1 trillion. We can see significant amount from the first quarter of 2019. So significant cash pulled from BlackRock assets. So definitely investors are a little bit worried. Doesn't really show in the markets because you're seeing the markets actually move up still. So definitely we're living in an upside down world, but I do think that in time, reality within the stock market will face the reality within the actual economy, which would be bearish for the stocks. And obviously with the deflation, I just can't imagine it hitting all-time highs and continuing up here. So we'll see how it goes. Basically, the question is, are you thinking that we're in an inflationary environment, which I just don't think is plausible, with velocity of currency absolutely plummeting, with individuals not spending money, with the lockdown, people not transacting currency, the velocity is going to absolutely plummet. And it's very, very difficult to get inflation if the velocity is spiraling down off a cliff. It's very difficult to get inflation. And you need inflation to get the rising prices of assets, goods, and services. So it's going to be a very difficult time for inflation to be seen in this market, in my personal belief, unless the Fed is printing an obscene amounts of money. So we'll see where it goes. This is the next topic at hand. It's a little bit grim. It's a little bit scary to some degree in my personal belief, but it's still a unfortunate, plausible outcome that could come from this devastating economy here we're seeing. They owe us trillions, Steve Bannon says. China must be held accountable. So this is my worry, and Ray Dalio says this as well. When you have a current power that is getting weak due to economic factors, and then you have a rising power, aka China, that is in a better situation, you're going to have a potential geopolitical war that starts with trade wars that can go into actual global war if it gets really bad, because no one wants to be number two forever. As China becomes the manufacturing powerhouse of the world, in their eyes, they probably think that they're the number one country in the world for manufacturing, that they should kick the United States dollar off the world reserve currency, because that's not fair in their eyes, because the United States dollar as a currency gets so much demand due to its global reserve basically standard or status, basically. So yeah, the United States gets a lot of positivity due to the Federal Reserve, or the world reserve currency, being denominated in the US dollar. They get a lot of benefit from that. But China obviously would rather not have that. China would rather have their native currency, yuan, become the world reserve currency, and they might do something about it. So we'll see how it goes. And the tension obviously is only going to make it worse. Steve Bannon, the country should be held financially responsible for the pandemic. They owe us trillions, if not tens of trillions of dollars, he added. So if there's tension, it's going to be a little bit scary. There's going to be first trade wars we've already had, then there's going to be restrictions on investors, on capital being allocated to certain countries. And then there's going to be currency wars, and then there might be an outright war. I don't know, so we'll see. U.S. says significant evidence coronavirus came from China lab. Putting blame on China, the United States reportedly looking to punish Beijing over coronavirus update. So in my opinion, it's a little bit scary, especially when this man, who has a temper of a child, who doesn't really think about things, he's put in power over the largest military really that's ever been on the globe. I just don't think that his temper with Trump, in my opinion, kind of having the maturity of like a teenage girl to some degree, and that's a really bad situation. If you have someone who doesn't think critically, who is very quick to make decisions, and who doesn't really think things through, in my personal belief, gets put in power over a very, very important task like deciding, how they should play this evidence and how they should play this this blame game on China. It's very scary in my personal belief, and Ray Dalio thinks so as well. So Ray Dalio is the founder of Bridgewater Associates, which is the largest hedge fund in the world. Ray Dalio is an absolute legend in the investing space. I very, very much respect him and his wisdom that he provides with his many books. All right, today, the market and political conditions mirror those of the late 1930s when World War II was beginning, according to Bridgewater founder Ray Dalio. So we did talk about this being a potential Great Depression with massive unemployment, with massive deflation, with huge amount of people not being able to basically pay their own wages. And this is very depressing. We could see a major depression here, like we have been potentially anticipating, with the huge job losses, with the massive deflation, with the massive job losses. This does look similar to the Great Depression. We have talked about the employment number. We haven't seen this high since the Great Depression, and it's only the second major month. We're going to see Q2 numbers hit, and it could be potentially Great Depression levels. So if that is the case, what is going to happen? Dalio laid out the similarities between today and the period ahead of World War II, while weighing in on what he thinks Donald Trump may do next when it comes to the China trade war. So quick update on the 1930s. In Germany, the Weimar Republic, in the First World War, they basically printed a shit ton of money to pay for the war, assuming that they'll able to win, and then if they have won the war, they have their world reserve currency, they can just tax the countries that they fought over, and then tax the rich, so then they could basically repay their debts if they won the war. But Germany lost the First World War, so they needed to pay their debts in the mark, which was their native currency. They did end up paying for the reprimands, the war reprimands, but that means they had to print money to pay for those war reprimands, which inflated the currency, which hyperinflated the currency, which is very, very negative for the economy. The people of Germany didn't think that they had a chance. They were very, very entrenched in depression, in not knowing what to do, because their economic situation was very, very, very negative. And when you have an economic situation that is extremely negative, when you have people that have nothing to lose, when they're at the very bottom of their economic, financial, psychological kind of state, where they're sad, when they're depressed, when they're angry, when they're frustrated at the world, you're going to have leaders that are going to rise up and say, it's not you, you didn't do this, this person did it, this entity is why you are suffering. So rise up and let's defeat this entity. And if Trump and if the American political leaders point that finger on China, we could have something similar to a third world war if that turns out to be something that comes into fruition, which is extremely scary. It's really not something to be looking for in a positive note, because people died. It's not really great for the economy. It's not really good for anyone. But yeah, with how things are going, that could turn into a possibility, because I do think that this is going to get a lot worse. And, you know, if China gets better and America gets worse, we could have these polar opposite economies that obviously are not going to be happy with each other, because America is going to look at China and say, you're the one who made us basically not world power due to lockdowns, due to COVID. And yeah, it's a very difficult time. It's a very scary time in my personal belief. So according to Dalio, three big forces that were converging that haven't since the late 1930s. So rising wealth and political inequality, which is one. Central banks' limited ability to stimulate the economy, number two. And a rising power, China, challenging the United States. So central banks only have one other thing that they can do. They've already lowered interest rates to basically zero, and a lot of countries in the ECB in China or in Japan have made negative interest rates, so they can't do anything in the monetary policy side. They can only do things in the fiscal policy side, meaning that they can only print more and more money. That's all they can do. That's literally all they can do is basically buy things, print money to try to stimulate aggregate demand. That's all they can do. The wealth gap between the wealthy and the poor, and political gap between the populist on the right and the left, are their largest since the 1930s. At the same time, central banks have a limited ability to shore up the economy in the event of a downturn. According to Dalio, the government could either substantially increase taxes on corporations and the wealthy, or the central bank could print money and buy debts that come from deficits. So basically, you have two options. You have one option where you're taxing corporations and the wealthy to bring more money to fund whatever you need. Or you can just print the money, but that is going to be taxing every single individual using that money due to the basement of currency, due to the fact that you are creating more dollars in circulation, which is going to devalue the total number of currency within that pool, right? So either way, you're taxing your citizens. You're either going to tax just the rich and corporations, or you're going to tax everyone. And right now, they are taxing everyone. They are lowering, they lowered taxes for governments. Trump did that. And then now they are printing money and giving it to individuals. So they are taxing everyone in the United States, really, and that's what they're doing. So yeah, I don't want to touch on this too much, but it is something that is slowly looming over, and it's a worry that I have. We talked about it before. We talked about it in a previous video, and yeah, it's definitely scary. Check out China's One Belt, One Road initiative. They have built infrastructure expanding all of Europe. They've built ports in Africa. They've built ports in Southeast Asia. They've basically secured the largest landmass available, and they've been building this for a very long time. That is how they kind of created and got their country, as well as surrounding countries like Australia, out of the 2008-2009 financial crisis, because they started printing and borrowing and making a shit ton of infrastructure, not just in China, but around the entire Southeast Asia, Europe, and basically infrastructure around the entire world to try to facilitate easier trade. Look into the One Belt, One Road initiative if you'd like to know more. So they've definitely built a massive economy. So definitely things are in the works in terms of geopolitical potential war, which is obviously a little bit scary, but we will see how it goes. All right. So let's get right into the questions, or not questions here, the charts. First things we're going to be looking at is the different indexes around the globe. So we got some from Europe, America, Canada, and Japan. So this is the Nikkei 225, which is basically the Japanese stock market here. In purple, hopefully you can see it. Let's just zoom in because we don't really need to be looking at anything other than this one. And then for every single index, we see that this red zone is going to be the 618 to the 50% fib level for every single one. So we can see Japan has barely hit the 50% fib. We can see that right here, and it's still making a series of higher highs and higher lows. We haven't even been close to making that next leg down, so we're still in the pullback phase, and it is basically going to be that for every single index that we're looking at. So in Japan, the stock market is still making higher highs and higher lows, still in the exhaustion pullback phase. Below the supply zone, which is good to see, Canada's TSX is just under the 50% fib level, still making a series of higher highs and higher lows, not really seeing the next leg down just yet. But we did see a pretty major rejection off the supply zone that we're looking at. Germany's DAX also has barely hit the 50% level, still seeing higher highs and higher lows. Not a whole lot. A lot of these indexes are showing similar types of structures where we are seeing a little bit of weakness from the exhaustion phase, but we haven't seen failure in any momentum to the downside. So we're still grinding up, moving towards the upside, continuing the pullback in my personal view. FTSE 100, which is the UK stock market, hasn't even hit the 50% mark. So this could be due to some factors. We see the Prime Minister get COVID, so that could be more of a psychological worry. But at the end of the day, we have seen the UK plummet and not recover nearly as positive as Canada, as Germany, or as Japan. So the FTSE is a little bit weaker than some of the other industries or sectors that we are seeing. And it did break a little bit. If we just move it like this, we could look at it. We could look at it a little bit more in detail within candles in a later video. But the FTSE 100 seems a little bit weaker compared to some of the other indexes that we've seen. The S&P 500 is the strongest out of all the indexes that we are looking at currently, with the 61.8% fib just breached by a wick. No candle closure above, but we did see the price poke above the 61.8% fib level, which is a little bit surprising, but we've come right back down to the 50% fib level, which we're currently holding right now, and we're in that supply zone. And we'll talk about the price action pattern that we see right here. Could be a nice little head and shoulders with the left shoulder head and the right shoulder that could potentially play out if it does hit 2870-ish there. We'll talk about that within the price action within the S&P. And then the Russell 2000, which is going to be the small caps, is still making a series of higher lows, continuing to push to the upside. We did see that 50% fib level breach to the upside, but it got rejected right back down, entering back below the supply zone. So overall, we are seeing the prices of assets move up, and we're not seeing any major capitulation, major leg down just yet in any of these major indexes. So it's definitely interesting to see. I do think that we will have another leg down, but right now, the short-term, somewhat positive news, I guess, and the positive sentiment is still in the market. We don't see any major legs downs in any market, so I'm going to remain patient, basically be a sniper, laying down with the scopes up, waiting for my opportunity. I don't see it just yet. The sentiment has still not shifted enough for me to add any short positions. But in terms of where we are in kind of the overall stock market for the world, we're still in that pullback phase. We haven't seen any major leg downs for any of the major indexes around the globe. So I do still think that we are somewhat in the feel-good moment in the first major correction before the next leg down. But you see value investors who are extremely good at what they do, like Warren Buffett, sell airline stocks. That does, in my opinion, show something for the longer term outlook for the economy. Because if you thought that the economy was going to turn back on and basically go back to 80%, 70%, 100% of GDP back to the normal economic movements, basically, you won't have Warren Buffett sell all of his airline stocks, but he is warning of a uncertain future, and I definitely am bearish, and I'm going to have that mindset, that sentiment, but we haven't seen that major leg down yet in any of the indexes, so I'm going to remain patient. I'm going to remain a sniper waiting for that opportunity, basically. All right. Haven't looked at the Dow Jones yet within those indexes. We've basically looked at the S&P, but Dow Jones has breached the 50% level, has not gone above the 61.8. And if we just get our little snip, quickly looking at simple market structure as well as kind of the nice ascending wedge that we have right here. We have our first little zone, which is our resistance. We see multiple touches of this area. Key level of resistance, we initially had this zone with the anchor point right here. First touch, second touch, we broke it, and then we rallied back up, breaking the recent high. And then I drew in another ascending trend line, which is somewhat creating a channel at this point. This was a wedge initially, like here. That was a wedge, but we broke the support zone, and then now I put it right here, right here, right here, right here. So let's get that zone, which also broke to the downside. And I'm expecting some level of a pullback, which is not a problem. But what we also see is now that we've broken this ascending zone, now we're looking for potential weakness from the bulls and confidence from the bears. So this is similar to the structure that we see within the S&P. This is the left shoulder. This is a potential head. We could see a right shoulder come in play here. Left shoulder, head, right shoulder, and then a move to the downside, breaking a key level of support. So I don't think that the major move is coming down yet. I will want to see on the Dow Jones things breaking the 23,000 mark right over here. That for me would be a key level for the price to pass in order for me to look for a more bearish entry and to get more exposure to the downside with that potential pattern. Or we could also see just a pattern with the break of the channel, the wedge, whatever you want to call it. And once you see the market structure break to the downside, let's just take all this off. So you see the major the major support zone right around $23,000 or 23,000 points or dollars within the DJI. And once you see it break, that's a major market structure support that breaks. Major loss of confidence from the buyers in my personal view. So if we see a lower low right here, we're looking for a lower high. Might not exactly reach the previous support, turning into new resistance, but that is what we're looking for. A major push, an impulse move to the downside. We're looking for an exhaustive move or an exhaustion momentum move to the downside, continuing our downside pressure. Push, pullback, we're looking for that retracement, creating our previous support into a new level of resistance before our next major low to the, at least to the bottom, if not lower, which is going to be around, 19,000. We'll see a little bit lower, but I think that low will be breached if we start to see that momentum to the downside. So that's the Dow Jones Industrial Average. Not really looking to enter just yet, but we do see a potential nice head and shoulders pattern. We did breach this ascending zone right here, which is giving me a little bit more of a bearish bias. But with the Fed injecting money, with the sentiment not turning just yet, and in my opinion, with the last kind of hurrah of the bulls before we see a major change in the confidence, I still think we will get some consolidation here before we start to move to the downside. But I do think May will be the major breakdown because we see a lot of earnings coming out, and that's going to give you a lot of potential perspective as to how a lot of corporations are dealing with the lockdown, dealing with the pandemic, because you can have a lot of hope and optimism for equities, but when you start to see the actual numbers come out and these very, very difficult numbers to justify the stock price, you're going to, in my opinion, going to get some level of adjustment due to the current state of the actual economy and the price of these assets, because they're not going to be similar. You're going to have a massively overvalued stock, basically, for what it currently is. In my personal view, is stocks are generally overvalued right now with the current economic situation, so I think they have to go down. So, yeah, in short, that's my view because of all things happening, and it may take a little bit longer than I expect, but that is completely okay. So that's the DJI. Let's now look at the S&P 500. First, looking at the weekly chart here with no TA or anything. Just look at this massive wick at the weekly candle. We got the price to move all the way up to above just 29.60. So if we do put the projection there, we did go above the 61.8 with just the wick, but we did inevitably close back down, and now we are seeing this nice big wick to the upside here, and it does create some confluence with major zones of resistance and support in the previous price action. So definitely it does show some validity around that zone. Also, we do have an expanding pattern that we can see within, let's just get this zone right here. So let's just go to the weekly. And then we have an expanding pattern with, I guess, a middle going right through. So if you can just extend this zone a little bit further, we can see it was first resistance, turned into a little support, but then in between here, it's not super well respected, but when we are looking at the smaller time frames, it does turn into a support, and it goes into a support again, and then the support for the third time before we get our major rally, and we're getting a significant rejection of that 2880 zone on the weekly chart. And then looking at the daily, a little bit smaller time frames, we do see that, in my opinion, we're still seeing that exhaustion move to the upside. We saw a low not get penetrated to the downside just yet. We're seeing another higher low potentially hold, so I don't want to enter just yet. I'd rather see a potential reversal pattern before we actually get any shorts into the market. So this is similar to the Dow Jones, where you got the left shoulder right here, you got the head right here, and then you're potentially looking for a right shoulder somewhere maybe around 2870, 2860. We don't exactly know, but that would complete the head and shoulders pattern, which would be a reversal pattern for the potential move to the downside. We could also see if this does support, or if this does support the price and holds as a potential demand zone. You could see a series of lower highs creating some descending triangle. You're looking for a break to the downside. But for the S&P 500, for the SPX, the major zone that we're looking for is 27, let's say 48, 2750. That's the major support zone that we're looking to see the price break before we are calling a major short opportunity here, because I do think the market's going to go lower. I do think that the Fed cannot keep the stock market out forever. We've seen Japan try to do that with 9 stimulus packages after the asset bubble in the late 80s, early 90s. It burst, and then the Fed tried to, or not the Fed, the BOJ, the Bank of Japan, tried to create enough stimulus to keep the asset bubble afloat. Did not happen. They just created a deflationary spiral for the last 15 years until they started QQE, quantitative and qualitative easing. They were in a deflationary spiral. So, it's happened before. Central banks have tried to stimulate the economy to basically stop a stock market crash, and they've failed. We'll see how the Fed does. I'm still bearish biased, but that is my current view of the market. I don't really want to be looking for a short just yet because the fundamentals are definitely there, but the technicals are not there just yet in my personal view. So that's the view of the Dow Jones stock market, overall markets in general. We're still making a move to the upside. We still haven't seen that initiation from the bears, that first major confidence push and the lack of confidence from the bulls holding the price up, we're still seeing interest in the bulls. So in my opinion, it's just too early to get that major short trade on. I was a little bit early on the first attempt when we started seeing weakness from the bulls. But hey, with the massive risk reward potential we have on this trade, in my opinion, it is completely all right to have one or even two losses before you get that good entry, because we are looking to hold for months. It's not going to be a 1 week trade. We're looking for capitulation of 25%, of 30%. Market decimation, market decimation. So we're looking for that major move in the market. This is like, in my opinion, The Big Short. I hope you've seen that movie if you're into finance. Fantastic movie, but that's kind of what I'm looking for. I'm not looking for a quick scalp. I'm looking for a major move. And if I'm shorting, and if I'm making 30%, 25%, that is unbelievable gains for the amount of risk I'm currently taking on this short trade. So definitely you got to understand risk reward. You got to have high conviction if you have a high risk reward situation when you're looking at both the fundamentals and the technicals, because yes, technicals are right now looking not super bearish, but in my opinion, it can't decouple forever. Stock markets and the actual health of the economy can't decouple forever. There has to be a point in time where investors lose confidence because there is so much bearish sentiment, because the numbers are so bearish, because the economy is not positive in any sense. There's going to be a loss of confidence. And when that day comes, there's going to be a major correction, and I want to gain exposure before that happens. So we're going to keep an eye out. We're going to keep looking at the market. We're going to play in technicals with the fundamentals. We're going to keep you updated for both situations, but as of now, super bearish fundamentals on the technicals and not super bearish just yet. Last thing we're going to be looking at is going to be the US dollar currency index. We did see a little spill from our ascending support that we saw right here. This was our nice little ascending support that was holding. We did get a push back down, but we were holding that 98 level of support. We did talk about a break of that zone, a breach of the support, but we're saying, hey, there is a level of support here where we've seen price bounce before. Don't be surprised if we see a bounce yet again, and it does look like we've seen it. We are pulling back to potentially retest this ascending support for a new resistance, but at the end of the day, I'm not super bearish on the US dollar currency index just yet, which is basically the strength of the US dollar compared to other major currencies like the 60% of the euro, 15% of the yen, just GBP. There is the krona, there is the franc in there as well. So this is basically just showing the strength of the US dollar against other currencies. And right now, we're just in consolidation. On the weekly, we saw a massive move to the upside due to the liquidity event in March, where you saw assets across the board get sold off, and then you saw a massive rally in the dollar. And now you're seeing a contraction or a squeeze or some funnel, in my view, where you're getting a series of lower highs and not really higher lows, but a squeeze in my personal view. And I think we could get another blast off to the upside if we do see another liquidity event occur, where you're seeing a second leg down, where you're seeing a scare of maybe a second wave of more of an economic factor coming into play. But in my opinion, you're gonna see another potential leg up because of the potential sell-off. But that's very short term. In the long term, I do think we might get a sell-off, but we will get a massive move down, because the economists in the United States, the modern monetary theorists that are saying deflation is the worst thing possible. The only way to curb deflation, in their eyes, is to print more and more money. Weaken the US dollar, right? They want inflation. They do not want deflation. So in a way to try to inflate the currency is by printing more. Japan's tried to do this for decades. They've tried to print themselves out of deflation, but it has not worked, because The increase in the monetary supply is only one part of the inflation equation. The other part is the psychology of the actual individuals within the nation. Are they savers? Are they going to spend money? Are they consumers? Are they going to save for a rainy day? Japan is extremely, in terms of psychology of individuals, a deflationary saving economy. They are not open to rising prices. They are not open to spending more money on goods and services than they already have. They are a deflationary mindset, and that is a self-perpetuating cycle where if you have a deflationary population, it's going to create deflation in the assets, which will create, it's a spiral, right? It's a spiral that is very difficult to get out of, because changing the psychology of masses is not easy. So right now, people are saving within the United States economy, and with the lockdown, there's going to be a very, very reduced amount of velocity, which is going to create additional deflationary pressure on the economy. And the only way that economists and monetary policymakers are able to basically curb inflation is by printing a lot of money. So they're going to do it. So in the long run, I do think that the United States dollar will collapse because there's going to be a loss of confidence in the macro scope of things, because they've just printed so much money and they're going to continue to do it. The only thing that they have to do to try to combat any economic downturn is by printing money. Literally, that's the only thing they're going to do. They've already talked about unlimited QE and basically zero interest rates. So that's basically the end game here for the Fed. They can't unwind balance sheets. They can only add on to the budget deficits by printing more money. But in the short term, I do think that we will, if we do have another major leg down, it will be a little bit more bullish for the US dollar with the with the milkshake theory, with the US dollar soaking up liquidity in emerging markets. Look up the dollar milkshake theory if you don't understand why I'm short-term bullish on the US dollar. I know a lot of people are thinking instant devaluation, instant hyperinflation, instant collapse of the US dollar, and in my opinion, it's not going to take like a week. It takes a very, very, very long time. It's going to be very challenging to get inflation, let alone hyperinflation, with the current economics that we're living in, with the lockdown, with almost no demand. It's very difficult to get rising prices if there is very, very little demand for goods and services, with very little velocity. It's not easy. But once you start to see the velocity increase, once you start to see people buying and selling, once you start to see increasing transactions, then you will start to see inflation rise. And then there's going to be a tipping point where inflation is good. People are happy. You're seeing the prices of goods and services and assets go up, which in my opinion is later down the line, like years I'm talking. But once that occurs, then in my opinion, there'll be a tipping point where it goes from inflation to hyperinflation because the velocity of currency increases and increases and increases, because people know that in a month from now, the good, service, or asset that they are going to purchase is going to cost more. So they're going to buy it today instead of waiting for a month, a year, when the currency that they hold is going to devalue and they have to spend more units of currency to get that same number of goods, services, assets, whatever it is. So they're going to buy it now instead of the future. And if the entire population thinks like that, the velocity is going to pick up exponentially, which is going to create even more inflation. And at that point, the central banks can't do anything. They can't. They could set price limits and they could do things to try to curb it, but like Weimar Republic in Germany in the hyperinflation, they can't do anything once the psychology of the masses values currency as a inflationary tool that is only going to hold their wealth for a short period of time. They don't look at the currency as a long-term measure of wealth. They look at currency as a mean of exchange to allow them to purchase real goods, services, and assets, and the cash itself is not a real asset because it devalues. Once that is set into the minds of individuals, you're fucked. You're absolutely fucked because the confidence is lost in the currency, and it takes a long time for that to happen. So that's basically my little spiel of the current economics, of the current state of the world. I'm not going to be trading DXY or anything, but it is, in my opinion, important to understand the potential situation of the United States dollar, the strength of the United States dollar. We can maybe potentially add some level of descending zone, but at the end of the day, I do think that this is just going to be a potential move up because we've seen that support hold. We saw a massive rejection off this 98 zone. Another rejection yet again. If we do see this zone hold, I'm currently just looking at it as a consolidation to the side, where we saw this descending zone break to the upside, which then I was like, maybe we could see a squeeze play out to the upside. I'm not super certain because we see a nice little grind up, and then you see 1, 2, 3 supports touch, but you see a resistance touch here, which was a previous level of support. So right now we're just in a consolidation going sideways, bouncing off of support and resistance. So if we do see the price break this mid-range zone, especially break this 101 range where you see a higher high and a higher low, then you're looking for a possible move to the upside, which would potentially be in confluence with the market moving to the downside as well. So I'm not trading DXY, but it's important to understand, in my personal view, where the strength of the dollar is. Because right now, it's in consolidation, and the fact that we've held this support 1, 2, 3 times definitely suggests that there's buyers in the market for the United States dollar, and we could see a little move to the upside because we've breached this zone before. We've held this for a while. It wasn't a little wick up and came right back down. The price was able to break, hold, consolidate within this range, which showed that there were buyers in this zone able to hold the price up. So it's not like this is a major zone of supply. It's a battle zone where not only just sellers, but buyers are within this range as well. So if we do breach this zone, we could get another consolidation, except this time, because we've seen the consolidation and the hold of this major zone so often, the buyers could gain confidence because we didn't do it this time, we didn't do it this time. We could see buyers come in for the second time, but because of the hold of the $99 range, they could gain more confidence to drive the price up further in the short term, which would be in confluence with potential sell-off within the S&P, within equities, because if you're selling an equity, a U.S. equity, you have to be buying the U.S. dollar, right? It's a trade-off. So that's going to be the video of the day. We went over the different time frames of the S&P. We went over the Dow Jones. We went over multiple different exchange, stock market exchange indexes in different parts of the world. And we went over the US dollar index. Thank you very much for watching. We will be doing another one in the commodities section today. So keep an eye out for that. If you did find this video informational, educational, entertaining, anything regarding you enjoying it, it'd be greatly appreciated if you did subscribe and like the video. It does greatly help our channel grow. Don't really have much else to say. It was about an hour video. Yeah, if you have any questions, it'd be really good if you put a comment below. We have been getting some frequent commenters, or people commenting, I guess you could say. Some good kind words. Thank you very much for those who have been commenting frequently. You know who you are. We really do appreciate the thought and effort that you do put into giving your thoughts, your opinions, your values, what you think. It definitely gives us a little bit more perspective of what other people are thinking about, and also create some good conversations in the comments so people can kind of have second opinions or have a different opinion, because in the markets, it's good to understand people's with different point of view. Like, I like talking to people who are super bullish on the stock market because I like wondering why they are so bullish on the market. They have their reasons, I have mine. So that is the completion of the video. We really appreciate you coming on and taking the time to watch this. And if you have any questions, drop them in the comments below. And until next time, have a good one, traders.